Conclusion. Corporations and investors invest in real assets that are intended to be productive in generating income. Some of these assets, such as apartment buildings, factories, offices, machinery, and computers, are tangible. Others, such as brand names and patents, are intangible. The decision-making tools of corporate finance assess the value of proposed projects and income-producing assets based on the time value of money and its relation to risk. We rank projects based on the present value of their future cash flows. How we do that is called discounted cash flow, DCF valuation. So let's take stock of the capital budgeting tools that we've talked about: net present value, IRR, internal rate of return, and accounting ratios. CFOs rely on multiple metrics when making capital budgeting decisions. There are pros and cons to IRR, net present value, and accounting ratios. What is important is to understand that each one of those data points represents an interesting and informative perspective. Using a portfolio of different capital budgeting tools helps make for better financial decisions, and NPV is by far the gold standard. We can also use earnings multiples and other accounting ratios that we talked about. They can provide interesting information but should not be solely relied upon to make capital budgeting decisions. Always include NPV and IRR. Include IRR and NPV next to ROE, return on equity, or ROA, return on assets, so that you can make a more informed and better decision. Use these capital budgeting tools that have a solid theoretical and empirical foundation and start making better financial decisions.